we're live, and I'm going to come back to you very, very shortly. So good morning, everybody who's watching. My name is David Highland. I am the CEO of obviously Highland Group. I'd like to thank everyone for logging in and watching our real estate conversation this morning. I'm going to start with some introductions. So we've got Anthony Bell, the CEO and obviously founder of Bell Partners, who not only look after us at a group level, but they're a big name in the accountancy space at a national level. Very warm welcome to Ros Coffey, who's head of culture and client experience in Macquarie Bank. We've worked with Macquarie Bank for well over 20 years. We've had Ros at a number of our events. You're an amazing sort of speaker and authority when it comes to culture in business, and I can't wait to come back to you in a minute with a few big questions. I've got the great man Bill Malouf, who's not only our partner in our Double Bay office, but obviously an authority when it comes to real estate. And I'm very much interested to kind of plug you in and get your view on what you see currently in the real estate market, but specifically how your clients are reacting to obviously what's happened this week with interest rates and so forth. So we'll be back to you soon. Last but not least, a big name in Macquarie Bank. We've got one of the leading, or if not the head economist, Martin Lakos. Mate, welcome and thank you again for being part of this panel. Martin will obviously add his spin and obviously a very sort of scientific view on what to expect probably over the next 6 to 12 months. So can't wait to sort of rip into that conversation with you. Guys, thank you again. I'm going to get straight into it. So what's today about? So it's obviously about giving our customer base and our clients an understanding from the people that we rely on as far as what's happening in the environment, and not specifically around real estate. This can be about any business specifically. So just to kind of give you some context, the last time we ran this conversation was on the 16th of July last year, which is kind of amazing, guys, because I can't believe 12 months has flown the way that it did. I was just saying to the panel that on the 16th of July, when we ran this, Sydney was in a major lockdown. But what was interesting, and I looked at this morning, on the 17th of July, if you can think that this was a year ago, the construction industry was paused. So all of construction went on hold, and that was obviously a massive event, in terms of creating blockages around development and whatnot. But there was obviously some major issues that came from that. So, and we might touch on that in a minute, but that was a significant time as far as the environment. And, I'm interested to know what everybody's viewpoint is, a year down the track. So the last time we ran this event, we had over 20,000 people view this feed, which is incredible. And it's a full credit to everybody on this panel as to the content. I'm going to start with Anthony Bell. So Anthony and I have worked together closely for over 10 years. Anthony, you're well embedded in the property space, specifically real estate, but then broadly, you're managing a lot of high net worth individuals and a very diverse mix of businesses. There's a lot happening. We just had a change of government. Rates went up dramatically this week. What's your view on the world and the environment at the moment?
Yeah, thanks, Dave. Look, my view hasn't really changed that much as it had a year ago when we first, were talking about where the state of the Australian economy was at, and also too where the state of the world economy was at. I guess you did correctly point out, Dave, that one thing that we get the opportunity to feel is a multidisciplinary practice. Is we feel property and real estate, we feel manufacture, we get the feel from our clients regarding retail, across a broad base of ranges. Look, in the general positions is that we've had 2 years of historic economic growth. If you go back even to the 2021 year and then 2022 year, there's been close to around 30% growth in some people's properties. It's been amazing. Bill will back this up when he speaks. Extraordinary pricing increases. The Australian economy and consumer confidence has revolved a lot around what's happening in property. So we're right to be addressing that in this particular forum. So, walk through change of government, yes. But what my take is, if there was ever going to be a changeover from a Liberal to a Labor government and have a relatively soft landing, this is the government to have a soft landing in. The policies are very similar. The attributions towards economic growth and stimulus are very similar. The new Liberal government, the new Labor government rather, is going to try and move to popularise itself. There'll be concerns over some of the historic worries with Labor governments coming in, indexing employment, individual rights, etc. But the bottom line is that a vote, to go forward now is this current government is probably going to be looked to make themselves as popular as they can. They'll keep stimulus up. They'll keep keeping small, medium enterprise alive. And that will translate, in my view, into solid consumer confidence. I guess the biggest thing that is dawning around is these changes in interest rates. But we've got to put things into perspective. And I defer, obviously, to Martin later on for his better view on it. But our take from what we're hearing back from our clients right now is, look, the predictability of where is this going to stop? It's probably going to stop at around the, 1.5% to 2% rise from where it was. And remember, we were almost at zero interest rates. We need to put that in perspective. So when this finally stops, we're probably going to be at about the 4% marker, maybe somewhere either side of 4. And up until the earlier part of these changes took place, people were loaning at about 1.6, 1.7, historically low. So we have to take that into account. Property markets will probably see this come off. As I said, we've had 75 basis improvements to 150. So we're almost halfway there. So when it finally levels out, and the economy goes back into a position, and I'm saying that level out is probably going to be December, January 2023, 24, where interest rates will stop going up. Everyone will look back and go, well, look, you know what, if there's been a 10% drop in property in the 2022 year, we've got to remember some parts are 30% up. So we're still completely on active parts. And I've been saying this for the entirety of my career, and an investment in property is not a 2-year investment. It's not a 3-year investment. It's a 10-year investment. And if we look at that, sort of on the historic lows, the bottom line is that the economy should be in okay nick once everyone settles into these changes. But the changes are really only, in my view and my clients' views, only levelling off, taking it from a very high point back to the midpoints to where it probably should have been and have been spread. I do think this, though, for businesses that, and there will be some issues that attack consumer confidence, Dave. It'll be a method where they'll be tightening of belts. They'll be spending both business to business and consumer to business that will have a question mark on it. And so this is a time really to take stock of your business, to really look at your budgets and forecasts for the 22-23 year. But it's a time also to take advantage of what a business-to-business transaction will be to gain market share. We've spent the last month on reforecasting budgets, but I'll tell you, the smarter players, the ones who have traditionally done well over periods, are looking at their marketing and their advertising spend, and they're actually increasing that because they see opportunity in what will be a transient market. Very similar experience. GFC saw Mercedes-Benz and BMW stop spending money on ads, and Audi started spending money. And by the time that GFC was over, Audi had gone from an 18% world market share to 33%. So that's where, we've got a lot of base and feedback that, this is really a time of opportunity. But again,
just off the back of that as well, sorry to interrupt. So there's been a lot of wealth that's been created through the SARS cycle as well, right? So, we're seeing it firsthand in our client base. I mean, a lot of business owners are going into this next cycle well-resourced, and well poised to take advantage of the next cycle and those opportunities. The good players are the ones that are now looking at this as an opportunity, correct?
Totally, Dave. And I think that mention that you had around people are well poised. I mean, they've got equity in their home now. The banks have been really jurisdictive. They've almost built this correction into place in applications over the last probably 6 months, meaning that they haven't overextended most of the mortgages. They've been concerned on valuations. And so there's been a good jurisdiction of, allowing people who are managing their lending and are managing their relationships with the banks not to overextend themselves, because there might be, sort of a flattening, sort of over the next probably 18 months or so. But here's the thing that's coming for us. There's some confidence factors. Australia is seen around the world as probably one of the best bases to both live and to trade in. Our unemployment rates are so high. So skilled migration is right on the cusp. If you think of everyone in America, through UK, through Europe, they're looking at pictures of Australian property. They're looking at pictures of the great lifestyle that we have here. The government had a policy in the Liberal government going back to look at skilled migration, bringing in, and making it easy for FIRB, for people to come to Australia, bring their skills, engineers, doctors, accountants, even lawyers, tradesmen, to come into Australia and actually improve the way that we build our country. And that's going to be still appealing. I imagine that Labor government will look at those policies and procedures and probably look to adopt a lot of them. And as we see our economy start to pick up, it'll be because we're the lucky place. Australian property is still undervalued compared to the rest of the world. Rates per square metre in Bondi Beach are half of what they are in New York City. And so as that sort of continues to grow out, we become a pretty attractive place. And that will also solve the labour shortage crisis that's on now. We're just starting to see the planes come back in. We're seeing 457 visa holders. And so production and productivity is something that you're exactly right. A great strategist is actually seeing a market of opportunity if their competitors are pulling back. I've sort of got it, we always talk about the 80-20 rule. I think 20% of Australian small business and medium-sized business will grow in the next year. But I think the other 80% need to really repack their bags and have a look at the way they're doing business. The transactions will continue to flow. And again, we're seeing a lot of interest from our client base saying they want to actually spend money in this economy to gain market share.
I think you're spot on. So I think the takeaways from, and I completely resonate with your view on things. It's there's nothing to panic about. There has been, and I think, you and I were talking through, that election period. It's like we were saying, well, if there's a change of government, everyone will wake up the next morning, the sun will come up again, life goes on type of thing. And it's very much that in the sense that, even at a real estate level, and Bill will probably have his own view on this in a few minutes, the market will settle in very quickly to these changes. Everybody's already factored in rate increases, and there's a lot of depth in the property market just broadly, not even limited to Sydney. You look at what's happening on the Gold Coast, there's been a complete shift as far as the demographics and migration, all those types of things. But what I like about your view, and I'm interested to hear from Martin later on this, is, there's been compression, there's been compression on business owners as far as, accelerating labour costs, and hopefully that will settle down, because it doesn't matter who you talk to, that has been one of the biggest challenges for small business, correct?
Look, it is. And if I go back, we've always lived in a world of, ABR, always be recruiting. ABR now stands for always be retaining. So there's countermeasures in a tougher economy where labour is at short supply and labour rates are going up. But this is a great time to actually look at your homogenised workforce and work out the things that are going to make those people more sticky to you. Work-life balance, work from home, extracurricular activities, training. They're all things that also add in on top of salary as well. And so, with that marker, we've got businesses that are absolutely thriving, but they were really smart 6 months ago when we're told that there was a labour shortage. They went and locked all their labour into long-term contracts, long-term benefits and long-term incentives. And I think that's the part, that it's a time to get back to business, a time to, repack your bags. Yeah, we've had an easy cake run with the money gone into the economy and the boom of the property market. That doesn't mean to say that, it was never going to stay growing at 15 or 20% per annum like it was during COVID. Remember, the Sydney property market alone, for those who are listening to this webinar, has doubled itself every 10 years over the last 70 years. We're well on track, if you look at 2020, to be well on track to being plus double by the time we get to 2030. And I'll say again,
I think you're absolutely spot on, and I'm going to come back to you in a couple of minutes, but I think one of the last points, and I think this leads perfectly into Ros's conversation. Ros, so off the back of what Anthony just said about businesses having to get better, as far as retention, what's your, so just broadly, not even real estate, like what are the best of the best in business doing at the moment within their businesses, specifically at a culture and team level?
Yeah, absolutely. And I think I was certainly nodding along to your comments then, because so much reporting in the media about this great resignation. The fact is there is a labour shortage in Australia. There's been limited skilled migration, and businesses everywhere are feeling it. It's regardless of the skill level and so forth. Our unemployment rates are at sort of historic lows. And so it's really about ensuring that when you are thinking about your workplace, you're creating an environment that the people you have want to come to, want to stay in, that you're thinking about what really matters to those people to incentivize them to be with you. And it's not just money. I mean, sometimes it is. There are some, certainly some inflationary pressures on wages. However, when you look at studies and interviews with various employees, other benefits such as flexibility, such as the ability to work from home occasionally, and being able to learn new skills and expand their own horizons will rate higher in terms of their priorities, in terms of their motivations to stay with an employer than salary alone. Money's a good way to attract people, but it's not necessarily the only way to keep them. Certainly a factor, though. Don't forget about that.
But just off the back of that as well. So you would have seen, I think, and it wasn't just limited to our business, but it was a very challenging period because on top of all of those pressures of running a business, nobody could take leave. There was a lot of fatigue, like we saw in our business, a lot of fatigue at the end of last year. I mean, how were the good operators reacting to those things from what you could see?
Absolutely. Certainly, I think those employers that took an employee care lens as opposed to, come on, we've just got to all keep going and get through this, are certainly the people that will have retained their loyal people by the end of, as we go through this next uncertain phase. So focuses on people's well-being. So you're right, people couldn't travel for holidays, but still letting people, or in fact encouraging people to take time out, whether it's with their families, just to spend time with themselves, to make sure they were working reasonable hours. People were checking in regularly on media such as these with Zoom. So a lot of companies were saying, if we're going to have a meeting, let's all have our cameras on so we can at least see each other and connect. And that way leaders had the ability to see a little bit more visual cues around how people were really doing. What we saw make a really big difference was people checking in at a personal level on how people were doing throughout that period of time, as opposed to, right, we've got to catch up on this work-related matter, how are you going with your job? It was actually just, how's your life? Because, life threw us things that none of us really had ever dealt with before. So that real supportive mechanism and focus on employee well-being beyond the day-to-day job really earned some loyalty points for those employers.
So post lockdown, you obviously the world's back on, everyone's traveling again. Business for the most part, I think it's outside of obviously some changes in the environment in the last sort of week or two. I think that the sentiment is positive. You're seeing restaurants full again. What are you specifically seeing as far as the best business owners, and what do their behaviours look like right now? So what are the lessons that they learned, right, and what are they implementing in their business right now? Is probably the better question.
Yeah, sure. I think two things. One, I'll stay with the ways of working piece for a second and then move on to their focus on clients, if that's okay. But essentially, from a ways of working perspective, again, any newspaper you read will have at least a couple of articles a week about which companies have which work practices. And because that's evolving, we are all learning we all had to learn how to work in a remote way. Now we're having to learn how to work in a hybrid way. Different companies have different perspectives on what's going to be best for their business and for their clients. The really, really important thing, I think, is to also take into account the voice of your people, because we built a lot of trust. We had to build a lot of trust in our employees to get their jobs done when we couldn't see them. We weren't seeing them at all for a long period of time in many cases. And so employees feel that trust was hard won and well-deserved. And now, when have points of view around how they would like to potentially balance their work and their life going forward. Not to say they want to work less. I'm not hearing that from anybody. I'm not reading any reports around that. It's just the way that they balance their work and life, and how, where and when and how they work is certainly an open conversation that the very best employers are having with their people. The second thing that the very best employers are doing, or the very best companies are doing, is this renewed focus on clients. Now, every company will say, of course, we're focused on clients. They're the heart and soul of our business. And truly, they mean it. There's this great study that showed 80% of CEOs agree that they delivered outstanding experiences to their clients, and only 8% of their clients agreed that statement was true. So that's not to say that they were intentionally doing a bad job. The gap can be explained through starting with understanding. So a lot of companies will come with the lens of, this is my business we're an expert in this area. Here's the service we provide, and here's how we provide that service to you. Come and get it. And those businesses who are really shifting towards the view of the client, what do they need? What are their concerns? How do we think beyond the transaction with the client to engaging in their lives seamlessly? Particularly in a time like this. So the last 2 years have been incredibly uncertain. As you've said, we're sort of coming out, but there's still a different type of uncertainty. There's a lot going on in the world that's giving people pause. And, COVID's not quite over yet. That's the other thing. There's a lot of people, I guess the unplanned absence rates in most businesses are certainly higher than they might be without COVID. So again,
incredibly disruptive periods as well. Can we just elaborate? So on the customer experience, so one of the observations that we had in real estate, particularly, majority of our consumer base was working from home. So you talk about customer service, there was a bigger focus in terms of response time. So the clients are looking for, they're probably, I don't want to say more needy, but there was more pressure on us to create more visibility, to respond to them quicker. I'm talking about 2-hour response times on inquiries, all these things that we hadn't really had to look at in past years. I think COVID, lockdown, working from home, and all of those factors are here to stay, has amplified what the customer wants out of their experience. Is that what you're saying?
That's right. And you're seeing it across the board, regardless of sector. Certainly, that expectations from clients around, as you said, turnaround times, around service levels and so forth certainly have increased. And so it's really, what I think the driver of that is people seeking certainty. So in an uncertain time, people are seeking certainty. They want an answer, whether the answer is a good answer, a bad answer, or good news, bad news, or something in between. That's what people are looking for. And so that's my interpretation of that driver. So I think the businesses that can provide that certainty really build that trust factor with clients. And what the importance of building trust, so that really comes from understanding their needs as opposed to the needs that they meet for you as a business, builds loyalty. So those people then stay longer. They advocate for you with their friends and family and say what a great place you are to do business. The other thing that then builds is then patience. So if they know and they have confidence and trust that when they come to you, they will get an answer and it will be a good one in their best interests, they'll wait.
I could talk to you about this all day, and I'm going to lead into Bill Malouf. But before I do, I think just to reinforce that view from our point of view, it's in times of uncertainty in our business, and speaking specifically about real estate, the consumers rely on safety and performance, and that really comes back to sort of at a brand level, and I'm not just talking about our group specifically, but at an industry level, as things tighten up, that's really when the good operators thrive, correct?
I think that's right. And I think that's right. And people who are putting clients absolutely front and center and understanding their needs and the emotion of what they're going to and can meet those are the people that will really build that loyal client base going forward.
Thank you, Ros. I'll come back to you in a few minutes as well. So big intro to Bill Malouf. So Bill is a veteran of real estate specifically. If anyone hasn't been following Bill Malouf's, sort of long and very successful career, Bill is probably the leading authority when it comes to prestige real estate sales specific in the Sydney market and Sydney waterfronts. Bill, how many cycles? Let's just start from your career. So and we won't sort of talk at length about this, but just to give the viewers some context, when did you start in real estate sales in Double Bay? What year was it?
1986.
Okay, so you've seen a lot more than I have, for starters, but you've seen all types of things, some dramatic cycles. I imagine through those 80s periods, you've seen escalating interest rates, all the rest of it, and then obviously it followed by GFCs and a bunch of cycles that have come since. Where do you see things at the moment? And I'm just talking specifically around the current month, the sentiment that you're receiving from your clients, and what's your view on things moving forward?
Look, I agree with what Anthony Bell said originally. In the real estate cycle, especially in the eastern suburbs and other areas, you see people doubling the value of their properties between the 10 to 12 year period. I remember in March in 2020, we all went into panic mode. COVID had hit. We didn't know whether the real estate market in the eastern suburbs, especially, which is where I operate, would hold its level or was it going to crash? We were uncertain of what's going on. And then we got educated very, very quickly. In a 3 to 4 month period, it changed dramatically. The market had actually increased in a lot of areas by double values. And I'm talking about properties that had traded at let's say, $7 million, all of a sudden, 18 months later, had gone from 7 to about 14 million. That actually doubled in that short-term period. Then what you also do is you get the influence of the press and the media. And I hate the words, I call it a correction. There is always going to be a correction in the marketplace. Whether that correction takes 5 years or 6 years to get to, there's an adjustment. But it's not a boom and a crash. And this is one of my great pet hates with the social medias and the news. They all love to say, market's gone through the roof or the market is crashing. Now we're talking about a 15% reduction in the property market. I personally don't agree with that. I think in the eastern suburbs, and let's talk specifically east at the present moment, there is going to be an adjustment. The rise that has happened in the last 2 years has been phenomenal for a lot of people, even in the 1 and 2 and 3 bedroom unit market. Do I see a correction going forward in the next 12 months or 18 months? Yes, I do. Is that going to be 15%? I don't believe so. Is it going to be 5 or 6% in the bottom, in the mid-range and below that in the marketplace? Yes, I think that will happen. But also you've got to appreciate that people that buy property are not turning that property over in 2 or 3 years. A lot of us will stay in those houses for 10 to 12 or 14 years. The reason we decide to sell, the children have grown up, they've moved out, mum and dad are living in a 600 square metre home, and really it's now time to talk about prestige unit sales. So the growth in that property over the period will more than compensate, even if they purchased a property in the high market. It will come back to them. So we don't need to panic.
And there's still a shortage of stock. Like, what blew me away about our sales business was the week leading up to the election. Like, we had a massive week. Like, we sold a waterfront in Cronulla for $20 million. We sold a bunch of other things between 9 and 20. Like, we had a huge. I've never seen anything like it. You talk about, there was a strong opinion that there'd a change of government, but I think that it's the old rule, right? The good properties are still selling well. I think at a Sydney level specifically, there's a lot of confidence in our market. But to be honest, I mean, I haven't really seen a huge change in our inquiries. I mean, you pointed out yesterday that there's still a fair amount of shortage of stock available in the market, correct?
This market moves on supply and demand, like anywhere else. The seafood market. If you go back 2 months ago, you could buy lobsters at $22 down at the markets. Now, the shortage of seafood in the country has meteorically risen dramatically in the last month or so. It's also the supply in the ocean, and the stocks are not coming through. And I make my judgments on the Wentworth Courier. Wentworth Courier after June, July, August, September, going through to Christmas, used to be 400 pages. The residential section in that paper has dropped by 47%. So we come back to supply and demand. Exactly what you just said a minute ago. The stock shortage in the eastern suburbs at the very top end on the waterfront market, there's probably 3 or 4 properties out there. That determines the value of those properties have risen dramatically. And I think the supply and demand will change slightly in the mid-range going forward in the next 18 months, but not to the level where it's going to crash the market in the eastern suburbs. You're 100% correct. The Wentworth Courier would normally go to 400 pages after the winter months, right through to Christmas. It last year was at 95 to 100 pages. That's a dramatic drop. And the demand for property, and you've also got to appreciate, after COVID, now people are realising, especially our expats, this is a great country to come back to and live in. Yes, there's inflation going on at the present moment, at 6%. Yes, the interest rates, but we were at interest rates of 0.25, for God's sake. I remember the days when the interest rates went to 19%. That's where you saw a crash. Our interest rates, as Belly said just earlier, that will probably sit between 4 and 5%. That's not going to kill the marketplace. We've got to work on that formula that people will start to look because they're downgrading, because the children have left, or they're upgrading because their financial situation has changed in the last 2 years. The money that has been made, whether it be in the stock market, whether it be in personal business, whether it be in transaction, has been unbelievable, the wealth that has been created. And these people, when it comes to the residential home, have decided to upgrade to a level or go closer to the water or look for greater views. Why? We're not taxed on our private home. And that's a very interesting point compared to the US. And more importantly, what they have made in the business, we all consider our house as something that we always wanted to own in this country. We're not a leasing country like other nations.
No, Australia's obsessed in real estate.
Exactly.
Yeah. And look, you know, and it's been said before, but well, it's gone from nuts to normal. This is normal marketplace. Yeah, and the other thing, like, you know, you touched on a few things, but as you're talking, I'm thinking like 10 years ago, our real estate markets were a lot more seasonal. So middle of the year, everyone has stopped trading. We haven't really seen that, even outside of COVID. We haven't really seen that for the last few years. I think the difference this year, like this is an interesting month. So we've had change of government, rates go up, people are traveling again. You made a point yesterday, a lot of our clients are heading overseas for extended periods at the moment. You know, so you're probably going to see a flatter June, July period for all of those factors. I think, and I'm probably going to just finish by asking you, you know, what do you see in real estate for the next 6 months in terms of activity, sales, confidence?
Exactly. Activity is going to stay about where it is at the moment. There is not a lot of top-end properties that look like are going to come onto the market. I said to you earlier that I think there'll be an adjustment in the 1 to 2 to 3 bedrooms or the $5 to $6 million house market. I think that will come back slightly, but it's not going to crash through the floors. I think we're still in a great period going forward for residential property. I think that every area is affected differently, and I can only specifically talk about the eastern suburbs, but I think the supply shortage will still demand a level of very acceptability in the price market in the eastern suburbs going forward.
Well said. As always, you're on point. Martin Lakos, over to you. I know everybody's sitting waiting to hear your sort of non-political view of obviously the change of government and everything that means for Sydney property, but just broadly business. You know, as a starting point, you know, like let's just reflect on what we're talking about a year ago. You know, what's changed? So, I mean, where do you think we're at right now? And let's start with the change of government. Anthony touched on a very good point that, you know, Labor and Liberal were very similar in terms of their policies. What's your spin on things?
Dave, thanks. Good morning. If I may, without embarrassing you, I'd just like to make a small correction. I'm not Macquarie's head economist. I'm just I was just
pumping up your tyres.
A very simple. Thank you. I appreciate that. I'm a very simple market commentator, but I'm very fortunate enough to have access to all of the resources and expertise at Macquarie's strategy and economics unit. So, you know, a bunch of very, very smart ladies and gentlemen. Look, what has changed from last year, which was really a year of recovery, that big V-shaped recovery, which was driven by all of that stimulus that governments and central banks around the world was pumping into the global economy. You know, zero interest rates, as Bill said, lots of stimulatory action by governments. 2022 is really, we're viewing as a year of transition now. And that transition is that basically the world's okay. We're really at more normalized economic data points, except for one key factor, interest rates. So interest rates really have been on emergency settings for a very, very long time. And there's absolutely no doubt, and we could be critical of the Australian Reserve Bank as we could be of the US Federal Reserve. Central banks around the world have been behind the curve. That is, they've been slow to react, but for good reason. They wanted to ensure that the imbalances that we're now seeing, you know, it's obviously coming to us in the form of cost of living and inflation rises. But we've also seen the fact that they didn't want to stifle the recovery. So central banks have had this job to balance things out. Now, quite clearly, the impacts of supply chain disruptions have really probably promulgated in a much higher level of inflation that even central banks were gauging. Now, can I just take a quick deviation here, just to put this in perspective, and hopefully this will alleviate some concerns about inflation. What we are now seeing is lots of anecdotal evidence that supply chain disruption is starting to ease. Let me give you some quick examples. So shipping costs quadrupled through the previous 18 months. They're now down 28% from their peak. Capacity on shipping is starting to improve. The disruption and supply disruption around computer chips has basically improved to the point where now production has not quite doubled from those low periods. We're definitely seeing things like work and delivery times improving. So there's lots suggesting to us that we've seen a peak. It will take another 12, maybe even 18 months for this really to work through the system, but we've probably seen a peak in terms of global inflation. That does mean that even here in Australia, these cost pressures will start to ease over the next 6 to 12 months. And that's really important, obviously, for businesses and for households. But it doesn't alleviate the pressures that we're currently experiencing. And you're going to get a lot of press around it. And definitely you're going to get a lot of commentary around the government in terms of the need for things to be done. On Tuesday, the Reserve Bank rate rise of 0.5, it was more of a surprise to us, not in terms of the 0.5. We'd actually were forecasting 0.4 for what it's worth, so it's neither here nor there, to be quite honest with you, is the fact that the indication or the signalling that the Reserve Bank is now providing says they're going to ramp up rate rises much faster this year than the market had been probably anticipating. That doesn't mean to say that interest rates are going to go a lot higher than what the market is currently estimating. And Macquarie's view is that interest rates will peak in the middle of next year at 2.5%. That's cash rates, okay? And from there, the Reserve Bank will probably take a pause. It's likely they're just going to ramp up a bit faster this year simply because of cost of living pressures. They've got to basically ensure that inflation pretty much returns back to that 2 to 3% range by which they want to manage inflation over the longer period. I think Ros touched on it, and maybe Bill did as well. The wage rises that we've been seeing around the world. Again, let's put that in perspective from an Australian context. We had 7 years where wages growth was not going forward. 7 years. So quite clearly, we need to see another adjustment take place, that there's a catch-up to be had. And unfortunately, it's an impost on business. The positive about wage rises is that the more money that households have in their back pocket, what do with it? They spend it. And that's clearly what we've seen right through the whole COVID experience, where the government did a fabulous job supporting households, supporting businesses, and the household savings ratio hit highs not seen since 1980. So again, households are in pretty good shape. So again, you're hearing all this commentary, there's going to be a lot of households experiencing pain. Yes, there will be some that do experience pain. There will be some that are over leveraged, and the cost of living pressures will hurt. But on the whole, along the average, most mortgagee households or households with mortgages are 21 months ahead of their payments. And you've got a household balance sheet that's in pretty good shape. You've got unemployment at 3.9%. So there's a reasonable degree of security in your jobs. And therefore, you've got a reasonable confidence that the income is going to continue to come through. So I think these are all issues that we have to put in perspective that seem to, a lot of commentary seems to lose sight of to some extent. So we're now at a year of transition. Interest rates are going up and interest rates are going to head back to slightly more normal levels. We do think there's a rising possibility of a recession globally, but it's more about looking at the probabilities and what does it actually mean. So if the central banks can't get a handle or can't get a grip on these pressures around the world, and these pressures around energy prices, skills shortages, certainly in the very short term, there's food price rises here in Australia, but that would appear to be more seasonal and due to the floods. But there's definitely going to be some price rises in food. This Ukraine-Russia crisis is going to impact the grain cycle, for example. These are things the world is going to have to deal with. And it's possible that we'll have a very shallow recession by the end of 23. We rate that as a 60% probability at the moment. It's more likely we're going to see just a growth slowdown rather than a recession. We doubt that there is a deep recession ahead of us. We've had a recession from the pandemic. We had a deep recession from the GFC, which is all about leverage. We don't see those same imbalances building over the next 12 to 18 months. But there's definitely going to be a slowdown, because when interest rates rise, that always does crimp activity by households and by businesses. So to be honest with you, if I was going to summarize where the position is, we're cautiously optimistic. We recognise there are imbalances building. Authorities are going to have to take action on those imbalances. And if they can manage it well, we'll come through it okay with just a slowdown in growth as against a shallow recession. And what does that mean? Well, we're currently tracking here in Australia growth around nearly 4%, not quite. I mean, our long-term growth rate is more like 2.75 to 3. So we're actually pedaling pretty hard here in Australia at the moment. And that's above average. That's above normal. And so you wouldn't be surprised to see that growth range come back a bit.
So there's a lot of people watching this feed that are involved in construction, property development, property, for example. There's a lot happening in the construction industry at the moment. So you're seeing massive blockages as far as labour. You're seeing some major building names, either going insolvent, or there's been some big changes in that space. What's your view for that? And because the construction industry plays such a big part in terms of our labour force. So where do you see things playing out in that space?
Yeah, and if you remember back, Dave, through COVID, the Master Builders Association really lobbied the government very hard, saying if we don't get some support for the building sector, there's going to be a 40% hole in a sector that's a big employer and obviously also drives economic growth. So the government came to the party and put in place Home Builder, and we saw applications for lending pick up on the back of that, and that sort of added a lot of confidence and certainly added quite a bit of construction activity. What clearly is impacting the construction space now is, one, as Bill mentioned, a modest cooling of the property market. And we'd agree with his scenario that we think property prices are probably going to go from peak to trough by about 8%. That's our forecast. But it's certainly not a crash, and it's certainly not 40% or 30% that some people are talking about. But on the construction side, we've seen a bit of a pullback, and as a result of which, we're definitely expecting to see some more problems in construction. That's largely around the supply chain disruptions. So in some instances, some building materials are up 40%. And yet some building firms have locked in contracts months ago, and they've been hit really hard by these cost rises. And that's hard to manage. So unfortunately, we're going to probably see a little bit more pain for the construction companies over the next couple of or in the next 6 months or so. I've just finished a national tour for the insolvency segment that we support at Macquarie, and quite a number of the insolvency experts were saying, that they think there'll be some more pain coming through. But overall, as a leading indicator, they're to some extent crying in their milk because they're not seeing enough businesses roll over. Now, that's clearly good news. We don't want to see that, but that's an indicator from the insolvency space that things are okay, that businesses are managing the business conditions reasonably well. So construction is going to slow. One thing that I think we need to touch on a bit more, and it says a lot around the skills shortages, is that historically we've grown very strongly in population growth. And I know I've quoted this before, but I'll quote it again if I may. So pre-COVID, Australia was the fastest growing country of any OECD country in terms of its population growth. In Australian terms, that was a growth of about 1.8% per year, roughly about 400,000 people. Half of that came from natural means, and the other half came from immigration. Well, we haven't had the immigration. So as that gateway is now starting to open, that will start to alleviate some of these issues around skills and skill shortages. And certainly when people arrive in the country, they tend to go and rent for the first 2 or 3 years, but they are all prospective home buyers or home builders. And so it's in that time frame that you would expect to see things to improve a little bit on the construction side as well. One other thing, and Bill might be able to confirm this for me or not, but my understanding is that the price differential between freestanding homes around the country and high density or apartments was the largest we had seen since the 1980s. And now that price gap is narrowing. In other words, investors are starting to come back into the fray looking to buy investment properties, particularly in high density, because to some extent they may have been priced out on the house side if they're looking to buy a home as an investment and to rent it out. So we're starting to see a pickup in buying in the high density side, and that's coinciding with this propensity to move to higher density. So rental vacancies are coming down. Dave, you'd be seeing that yourself, and rents themselves are rising. Well, that's probably going to continue as our immigration starts to reopen up.
And that will underpin the market to a greater degree as well. So one last question for you, and I know that you take a very measured view on this. When there's been a change of government in past years, and we certainly hadn't had one since I think 2014, I think it was, when Kevin Rudd was in, how do you see the impact of the change of government right now? And I know the bank's view is quite neutral on this, but you personally.
Yeah, I mean, Macquarie doesn't have a political view, but the sort of the comments around this, please take it as my personal view, if that's possible. Look, firstly, pretty obviously, and I think you mentioned on the opening remarks, Dave, there really wasn't a significant policy differential between the two parties going into the election. And I guess, maybe it was it's a time moment that, we had a coalition government in power for 8 years and the population was wanting to say, well, what can the other party do? Look, the new Labor government is inheriting really a position that's reasonably good shape, but with some pressures, which we talked about, those imbalances. And there's obviously been a lot of rhetoric already around focusing in on cost of pressures for households, particularly around things like energy. The government really can't do much around food, to be quite honest with you. That will start to settle down itself. I think going forward, it's really what the new government is going to do that wasn't within the election articulation. And of course, that's something that we just don't know. We're going to have an early budget in October. It'd be very interesting to see what the government will try to do to address these cost pressures for households going forward. There's been a lot of talk that the Labor government wants to support a 5.1% wage rise. Now, that's going to go to the Fair Work Commission. Just to put wage rises in perspective, the last two decisions was 2.4 and 2.7% by the Fair Work Commission. And they look at a whole range of factors. Cost of living is obviously part of it, but they also look at what the Reserve Bank does, and they also look at what inflation is doing. And the component of inflation that they really look at is not the headline rate. The headline rate is currently 5.1 and probably going a bit higher. It's the smoothed rate, what we call the trimmed rate, the trimmed mean. And that basically smooths out these big volatility around energy prices, food prices. And that's tracking a touch over 3. So it's more likely that if I had a crystal ball, the Fair Work Commission would be looking at a 3 to 3.5% rise. Now, that still is an impost on business, but it's also playing a bit of catch up. So I don't think businesses should be overtly concerned by that, coming from a 2.7 to a 3 or 3.5, but it does mean that wages are going up and the cost of those wages are also going up. But so many businesses, the real estate business, certainly financial services, are seeing wages going up or salaries going up and have done for a while. If you speak to lawyers, if you speak to accountants, I'm sure Anthony can confirm this.
Hospitality,
in the professional,
everybody you talk to is in exactly the same boat.
It's already happening.
Thank you for your obviously well measured information, and I know everyone that's watching this would have taken a lot out of that. I'm just going to, we're running out of time, so I'm going to skip. I've got one last question that I'm going to fire off at Ros, and maybe you can answer it first, and Anthony at the same time. What's the best advice you could be giving small business owners right now?
Best advice. Look, I think the advice is really around shoring up the business. In other words, when I said that sounds like there's a disaster happening, and we've heard very clearly from our economic experts on this call, that's not the point of view. But I just mean it's always a good time to take stock. Ensure that the lessons that we've learned over the past 2 years in terms of evolving businesses are embedded, but we have a view to going forward, and there's not just a snap back to ways of working, because that's what we used to do. And the biggest piece of advice is really to start with client. The fact is that all of the businesses we're talking to today, I'm sure, are reliant on clients for their longevity and their success overall. And as we've talked about, people's opinions are evolving, people's situations are evolving. And we continue to be in a time of uncertainty. So if you're starting with client, what they need, understanding their personal situations and their business situations, and delivering to those needs, then you're on a sustainable path to business success.
Excellent. Okay, great response. And obviously just creating separation between yourselves and your competitors, I think off the back of that's critical as well. Anthony, one last piece of advice before we wrap up. The best advice you can give small business owners that are watching this right now.
I think right now, mate, it's a time to be vital to their customers. Okay, no matter who you are, no matter what business you're in, there will be a movement to trusted operators and trusted brands. So you won't feel a downturn if you're incredibly part of your customer's team, the vital person, the person of significant influence or choice. So I think it's a time to up customer service levels, up relationship work. And obviously the deliverables of what you give in advice and people wanting advice, exactly as been said before, to be absolutely bang on accurate. The second part is keep a good eye on cash, okay? The cash flow cycle is going to get a little bit tougher. So work on your cash collection systems, work on the flow and keeping the flow of money. It's almost like watching that, because there'll be a natural propensity as things tighten in some quarters of the economy, and so too with the cash flow sector. So it's part one, run your businesses as impossibly efficient as you can. And on the second part is watch the cash flow cycle.
I think there's some great advice there. Look, a massive thank you to our 4 guest speakers, Bill, Ros, Martin and Anthony, of course. You guys have been invaluable as far as experience and information. I think this will be very well received from our customer base. So a big thank you for your time. For anybody that's watching this, if you wanted me to personally connect you with any of our 4 guest speakers, if there was a conversation to be had, please reach out to our head office on 9523 4333. Again, thank you to our speakers, and hopefully we'll be able to do this in the foreseeable future. Have a great day, guys.
Thank you.
Thank you.
Thank you.